I see we have Rob Roy coming up. Rob, can you hear me?
I can hear you.
Okay, Rob, go ahead and get your PowerPoint up. Um, Rob Roy is a 25-year veteran of financial markets and currently serves as the chief trading strategist at Elliott Wave Options. After an initial 13-year career as a PGA golf professional, Rob entered finance in the mid 1990s, and Elliott wave analysis became the cornerstone of his trading approach. A seasoned educator and global speaker for over 2 decades, Rob has a unique ability to explain complex market concepts so even novice golfers can grasp them. Rob, I got to ask what your handicap is.
Well, I did get my amateur status back, so I'm a four now.
A four.
Yeah.
Have you ever had a hole in one?
Interesting that you asked that. No, in all the years I've played golf, I started playing golf with my dad at 12 years old. He had nine. I've had zero.
I got one hole in once on a par three. I whacked the ball down there. We went to look for the ball. We couldn't find it anywhere. Finally, somebody looked in the cup and the ball was in there.
If all else fails, look in the hole. Yeah. Boy, I've
Yeah,
had to do
really.
everything. I've had to defy gravity hanging over the lip. I've destroyed the back of the cup because it almost slam dunked. I've done everything, but it just hasn't happened.
All right. Well, there's always hope for the future.
I'm with you.
Okay, I see AI powered Elliott wave. I'm going to go ahead and mute myself and you have the floor. And then we'll give out the next batch of prizes.
Okay, sounds good. Hi, everyone. It's Rob Roy. Welcome to this special event on the 25th anniversary of the Mad Hedge Traders and Investors Summit. Very happy to be here, especially on such a monumental event. And if you see the words Elliott Wave and you're not necessarily an Elliott Wave fan, I ask you to just have an open mind. Wait till we go through the presentation. I think I'm going to show you something that is new to you, but I know I'm going to show you something that'll be exciting for you. So with that, let's go ahead and move forward. What we're going to cover throughout this presentation, I probably will be talking a little bit quickly, but there's a lot of great information that I want to get through to you. We're going to talk about the difference between Elliott wave analysis and trading. Maybe some of you have some experience with Elliott wave. Maybe some of you don't. You've heard about it, but don't know much about it. I think there's a differentiation on the way we do it versus how a lot of quote Elliotticians do. So we're going to cover that. Go through trading opportunities in the wave three. If you have familiarity with Elliott wave, you know that's the strongest of all the waves. And then we kind of supercharge it with AI that's been infused into Elliott wave. What an exciting thing that is just on its own. We'll talk about actual performance because that's the key, right? Why are you here? Why are you listening to me? Why would you be interested in this? How's it performed? And we'll show you actual performance, not just back tested. And then we're going to give you a plan detail so you can see exactly how it works in trading in the wave three. That's the key. That's what I like to focus on. So let's go to one of the topics that I talked about, trading versus forecasting. And there are a couple different ways of doing it. I've met a lot of people that trade Elliott Wave, and they consider themselves, I call them Elliotticians, but they say they're analysts. We like to look at Elliott Wave more from a trader's approach to it. In other words, we're not so tied into getting every single move labeled properly with sub moves and sub minuets and all those kind of things. We don't do that. We focus on the bigger picture side of things. So an analyst may manually identify trading counts, and boy, have I met a lot of people that think they can do it by hand. If you've ever seen the Elliott Wave algorithm, I actually have the full-blown algorithm, and it is pretty intense. If you have a superior mathematical brain, maybe you feel like you can do it. I use software to do it. for me that's programmed exactly to the algorithm. So we work off those algorithmic um, counts, and Ellioticians tend to focus on a particular market. We look at the whole market. Where are the opportunities versus a wide range of market opportunities? So the analyst goes into a deep dive, if you will, on their analysis. I'm just looking at the higher picture. What is it telling me as far as where the stock could go? That's really the bottom line. Is it going to go up or down? Which is another beauty of Elliott Wave. I'm an options trader, so we trade upwards or downwards, as you know, and Elliott will give you um, setups for upwards or downwards. So typically, an analyst wants to know where things are going to go on the longer term. But as an options trader, obviously time matters. You have theta decay in the options, so you want to be right on a shorter term time frame. So our focus is on that shorter term time frame. I like to be in trades 2 to 3 days, 2 to 3 weeks. That's my goal. And so that's the type of setups we look at. Doesn't always work out that way, but that's the goal when we first start out. So an analyst might try to forecast or predict key market trends and turning points, etc. I just want to find opportunities within a particular move that is existing at this moment, not further out in time. So again, primary difference there is the shorter term focus. So one of the things that I want to talk about is something known as a zigzag. If you are Elliott Wave or have some familiarity with Elliott Wave, you'll understand what a zigzag is. If not, I'm going to show you what it is. It's pretty basic trade setup, but primarily we focus on doing it in the wave three. And from a pure Elliott Wave standpoint, most people will say, stay away from the wave three because you don't know where the wave three is going to end. Even though anyone in the world of Elliott Wave agrees the wave three is the strongest of all trends, the knock on it, if you will, or the caution is that you don't know where a wave three is going to end. Well, I'm going to show you a way that you can get a reasonable expectation of where that wave three may end, which allows you to participate in the strongest of all moves. So when we talk about zigzags versus adding in Fibonacci extensions, and I should say that I've been trading Elliott Wave. Thank you for that nice introduction. I've been trading Elliott Wave since 2001, and I've been trading since 1996. So I traded it for 5 years with other standard indicators, and then a person that unfortunately is no longer with us, was killed in a tragic accident, showed me something on 9/11, before 9/11, showed a massive expectation from an Elliott Wave pattern of a big move down in the NASDAQ. So pre 9/11, he showed me this, and I was like, there is no way this is going to happen. It's hocus pocus. It went in one ear and out the other. And then 9/11 happens, and the NASDAQ went down to the exact point that he had predicted to me. That was my epiphany. That was when I said, okay, I'm at least going to take a look at this. And boy, I bent that poor guy's ear for hours upon hours, day after day, wanting to learn. And this is a pattern that I focused on because I started reading Elliott's works, started reading everything he has published. I found some side notes that have never been published, etc. And he talked about this thing called a zigzag. It's a three-wave pattern. Now, it's identified as a corrective pattern. So if you have some knowledge of Elliott Wave, you will be used to hearing after a wave 5 pattern ends, you're going to have one of three things occur: a flat, a zigzag, or a triangle. Those are known as corrective patterns. However, a zigzag actually is a directional pattern. It's a three-wave directional pattern. And Elliott himself, being a mathematician, I don't want to spend time going through his history. You can look him up, but he was a noted mathematician, used to work for the railroad, got debilitating disease, and then started focusing on the markets. And that's where it came from. So there's a brief rundown of it. But he talked about how this was his most accurate pattern, or the most accurate pattern in his opinion. So I was like, well, if he thinks this is the best thing, then I'm going to take a look at it. So basically you have, and it's labeled ABC rather than typically the 1, 2, 3, 4, 5s that you see with Elliott Wave pattern. You can go out on the internet and Google Elliott Wave, and you'll see a 1, 2, 3, 4, 5 followed by an ABC. those are the corrective patterns that I mentioned, flat zigzags or triangles. So that's where the zigzag got its name as a corrective pattern, but it's directional in nature. So Elliot was a big believer in Fibonacci levels. I was too. So there was some synergies there already. Helped my anticipation of what we could do with this. And so you have a labeling from a 0 point to an A wave impulse, a B wave correction, and then a C wave extension. And you can already see over on the right-hand side, we're going to look at some Fibonacci levels to give us an idea of where that C wave may end. So even though it's labeled as a corrective pattern, it actually is a directive pattern. They're the exact same thing. And I always get into discussions of people that say, why do you call it a directional pattern as a corrective pattern? And I've given you the reasons why it's labeled that. In truth, they're the exact same thing. So let's talk about it. Let's talk about how you can trade zigzags within a wave three. So we identify the patterns. And for those of you that may not know, every 5-wave pattern within Elliott wave starts with a zigzag. So it starts with this pattern that we're looking at. So there's your 1, 2, and 3 there. Obviously, this is forming into a 5-wave pattern. Now, not all zigzags turn into a 5-wave pattern, but every 5-wave pattern started with a zigzag. So how can we take advantage of trading the strongest of all waves and without getting into too much Elliott wave detail? Again, trying to condense this and give you as much information as I can in the space that we have here. When you take a look at the moves here within the Elliott wave pattern, the wave three, most people say in the world of Elliott wave, wait till wave four starts. So if you have wave 1, 2, 3, and 4 already in place, then you have a higher percentage chance of trading the wave 5 or the wave 5 doing what it's supposed to do. But the wave 5 identifies retail trader action, where the wave 3 primarily focuses on institutions. So who has the deeper pockets? I think you already know the answer to that. Institutional trading have far more volume, hence the reason the wave 3 is viewed as being so strong. So if we can identify a zigzag within a wave 3, now we're interested. Now we have a setup that we look at that we can go through and identify. There are opportunities. We could talk about that another time within the wave 4 and the wave 5 as well, but I'm here to focus on trading the zigzags within the wave 3, so that's going to be the primary target. And oh, by the way, not only do we get entry targets, we also get exit targets. So both things. You know, when you get into a trade, the key becomes when do you get out, right? How do I know when to get out? Am I getting out too soon? Did I wait too long? Well, we can give some pretty reasonable assumptions as to what the best time is to both enter and exit the trade. So how do zigzags help the wave 3? Well, first of all, they give us that opportunity of when to get in. And we're going to go through specific rules that we look at on when to enter the wave 3 pattern. And maybe you're familiar with this, maybe you're not, but when you're looking at a 5-wave pattern, the 5-wave pattern does not initialize on the algorithm that Ralph Nelson Elliott wrote. By the way, he wrote this over 100 years ago. So this is something that's been around for a long time. This is not a fly-by-night thing that just showed up. It's been around for a very long time. So when the 3-wave is identified, the 1 and 2 are labeled. That really doesn't matter to us because we already know what the rules are of the zigzag from the ABC side of things. So it doesn't matter if the 1 or 2 are labeled yet. We're going to talk about those from an A and B standpoint. So there you can see a setup. This would be a primary setup where you had the wave 1 impulse, the 2 correction, and then we start looking at the zigzag within the wave 3. That's when we get excited. We can get in, we can get out. We're not necessarily interested in hitting the exact bottom or the exact top. I don't think anybody can do that consistently. We're just looking to take a nice chunk out of a strong move. And boy, in this market that we're in now with all the AI stocks and everything, there's a lot of opportunities here along those lines. So zigzags also give you the exit target, and that's primarily based on those Fibonacci levels. I'm going to give you the rules, but they're primarily based on Fibonacci levels. Now, one thing that we have done at Elliott Wave Options is to AIify, if you will. I don't even know if that's a real term, but it sounds good for what we're talking about, the Wave 3. So everybody's using AI in some sort of version, right? Well, I contacted this group called Hub, HUBB.com, and they are one of the pioneers in injecting Elliott Wave and AI. They were believers in both. And so they had the idea. I did as well. So we consulted on it and we launched an AI service utilizing what I'm going to show you. I'm going to actually show you some of the AI coding here. If you're stronger in math than me, you can figure it out. Good on you. I just look for the big pictures. I'm a visual learner. So seeing the patterns play out is something that I do pretty well at. Not trying to say I'm the smartest guy in the room. Far from it. As was mentioned, I'm a former golf pro. So I'm just an average everyday Joe. But in taking an IQ test, and I'm taking several of them, there's no doubt that my strongest suit is visual spatial recognition. Basically, what that is pattern recognition. So trading patterns is kind of right in my wheelhouse, if you will. We actually launched the service in 2021. So as I mentioned, AI is everywhere now. People are creating their own AI models, but we were in the forefront. I really believe that. So not only had we developed it in 2020, we started sending out alerts to subscribers in 2021. So we have a long history. You all know AI is moving at the speed of light. And if you have true AI, which this is, it's learning on itself. So it consistently gets better and better, smarter and smarter as it goes through and analyzes which setups worked, which ones didn't, and it constantly improves it. So if we started in the front or out in the forefront, seems like we're going to stay there, which we firmly believe. So the Elliott wave calculation and AI ratings are separate functions. The only Elliott wave function that is included in the AI side of things is the very first day that wave 3 is labeled. So we do want to try to get in as early as possible, but nobody can get in at the very start of a wave 3 because that 1 and 2 aren't labeled until the 3 is actually labeled. And we'll go through the rules on when the 3 is labeled, but that's it. The AI model takes just that one piece of Elliott wave. So all the different AI things that go into this are added into the Elliott wave rules. So how do we use it? The data scientists at Hub provide extensive data analysis for the algorithm. It includes price to volume, indicator values, benchmark comparisons, rankings, statistical measures, intermarket correlations, economic cycle data, company options data. And, you know, if you're a trader, you're probably looking at things and saying, I can find that. I can do that myself out there on the internet. Well, those are only a handful of the over 300 data points. And in addition, the AI uses regression, clustering, random forest, ensemble models, as well as neural networks. And when I look at that, the only one of those that I really have any sort of familiarity with is neural networks. I know in general what that means is that you give the AI a problem or a situation and you ask the AI to solve it. That part I got. That's about the depth of my knowledge along those things. So when I look at that stuff, it's Greek to me, as they say. I mentioned I'm a visual learner. So I asked the guys at Hub, the data scientists, could you give me some visual representation so I can see? And this is what they sent. To me, it looks like an ultrasound pattern. But the key is the clustering of all those dots. All those dots are all the data points within, and you can see at the top, it's coded. So all the dots represent hits within this one data point, the code from the one data point. And as I mentioned, there's over 300 of them. So there's a ton of these that all create their clustering patterns. And I was looking at this and saying, okay, I can see the clustering from the visual standpoint. Still looks like an ultrasound to me. And then they condensed it down and said, well, how about if we just combine it in? And they sent me a representation of what they consider to be the 36 most important data correlations or the highest impact correlations. So the key here when you're looking at this chart is you see the clustering in each one of those data points. Now imagine if you could come up with results from over 300 of these where the clusterings tend to agree, where the data correlations agree the most in each one of those data points. From a common sense standpoint, doesn't that feel like that would up your percentage of accuracy or the potential percentage of accuracy? We know nothing in the world of trading is 100%, nor is this. But we're trying to give that edge. We're trying to put as many data points, as high a percentage of potential accuracy in our hands as we can. And this has helped tremendously, and you'll see the results. For the subscribers, all that stuff, all those ultrasounds come into a chart, a price chart that looks like this. So it's all just comprised and made as simple as possible. It gives you a target price on where the stock can go and a fail zone. So as I said, nothing works 100% of the time. So how do we know when this pattern has become disqualified in the terms of LA wave, or when this pattern may not come to fruition and work out? So you have your stop. That's what the fail zone is. And then up in the upper left there, or in the mid to the right, I should say, it gives you the AI confidence score. And in general terms, we're looking to enter alerts only if the score is 75 or above. So if you feel like having a 75 or greater percent chance that you're going to be right, I mean, what from just a calming standpoint, a confidence standpoint, would that do to help you in your trading? So pretty good chance that's going to occur. Again, there's still a chance that it doesn't occur. An 84% score is pretty high. We see them around 90, 92 at times. I don't think I've ever seen a score higher than 92%. But as you can imagine, that's about as good as it can get in the world of trading. Most of the time, people say if you can be right 80 or 60% of the time, you're doing well. One thing I like to mention is if you're not currently trading with AI, you're trading against it because it's out there. And so join the party, or, try to remain status quo and fight the crowd. But this is where things are. And as I mentioned, I feel like we've been in the forefront of this. And those that think that, oh, well, I saw those models, I can do it myself. Boy, if you have not only that scientific brain, that mathematical brain, but you have large computing power in order to process all those data points, correlate all the data points, find where those clusters agree, and then spit out a result, you don't need the software. Otherwise, you can go to hubb.com, and you can currently, because it's still in beta testing mode, which means you can get it for free at this point in time. It will come out later on as a potential subscription, but for now, you can go to hub.com and get the software for free. So let's show what our published track record is. I mentioned that we've been sending out alerts since 2021. We started doing these zigzags within the wave 3 back in 2023. And so that's what I'm here to talk about. So we'll talk about the results from that specific setup, the zigzags within a wave 3. You can see the ROI is 22%. You can see the average there. And you look at that and say, that's not a lot. It's not a big, sexy number. But again, we're trying to catch a piece of that wave 3 move with a much greater percentage chance of being right. And that's reflected in the number of winning trades. 84% of the trades are winners. And when I first started trading, if somebody would have shown me or told me or tried to convince me they were right 84% of the time, I would have walked away and saying that's not possible. But this is documented. These were alerts sent out to subscribers. So there's a record of this. And then that translates, since 2023, a cumulative account return of 331%, or 124% per year. And then you go down in the bottom part is broken out by years from 2023 through where we are here in 2026. And you can see the returns, the cumulative returns. The thing I want to show you is look at the drawdowns. We always want to know what the drawdowns are. So they're minimal. And then look at the max consecutive winners. 19 consecutive winners we had in 2023. In 2026, we're at 17 consecutive winners. So a lot of right trades. And then when you're wrong, yeah, there was in that same year of 2023, there was a point, even though we had 19 consecutive winners, there were 5 consecutive losers. So, not trying to say this is never wrong. We're showing you everything, peeling back the onion skin, whatever you want to call it, transparency. It is wrong at sometimes. There are going to be losing trades. But when you see these kind of numbers, you can equate it to the fact that you make more than you lose, then you're moving forward in your account. So when we break it down, you can see that on the monthly portfolio return, they're based on starting capital. That's why we call this hypothetical. We're adding subscribers all the time, so we can't show compounded returns. That wouldn't be fair to somebody that just started up. So we assume every time we enter an alert that you're starting with a $5,000 account. That's the model that these returns are based off of. And you saw that growth. I'll go back and just refresh it here from starting at 2023, the profits up to where we are now, and that's through April of 2026. The profit returns are over $16,000. And again, that's based on no more than $500 at risk per trade. Everyone has a different size account. You can scale it based on your own account size, on what size contracts or trades you'd want to put on. And then you can do your own calculations on, well, what would those results have been if it was compounded instead of non-compounded results? Well, notice on the monthly returns, there have been a couple red months. Again, doesn't work all the time, but the majority's green. The majority's moving in the right direction. And then we go back to look at the monthly returns on the signals from, we call it the impulse AI trade. That's the wave three. That's the zigzags within the wave threes. And again, assuming $500 in each alert that goes out and building your portfolio from there, you can see the monthly returns. Again, a couple red months in there. So there were some negatives, but for the most part, I think anyone looking at that, if they saw that those are the returns that they were receiving, they would be pretty darn excited about where the potential is. So let's go through this. Let's talk about how we do it. Elliott was big on having rules versus guidelines. So hard, fast rules within Elliott Wave are it must follow these rules or the pattern's disqualified. And then guidelines were basically, to summarize, Elliott's own observations of what was going on. So when you're looking at a zigzag pattern, by rule, following that A wave impulse, the first impulsive move, you look at that, okay, well, that's our benchmark. That's where we start. And then when the B wave correction comes in, the algorithm will actually label that if there's at least a 20% pullback. And that gets to the first fib level of 23.6. Again, Elliott was a big believer in Fibonacci ratios. So that's what it takes to actually follow the rule. It's not even going to give you a setup if that B doesn't go at least 20%. And then his guideline was, yeah, that's the rule. I'm going to acknowledge the 23.6% fib level as far as a retracement or corrective move, but to me, that's the weakest of all. I'm paraphrasing what Elliott said, the weakest of all Fibonacci levels. He would prefer to see it get closer to a 38.6%, another fib retracement level on its pullback, and that's where I follow. So I like the 38.2% level as well. So rules versus guidelines. We'd like to see that B wave at least 30% of a corrective move from A. Now, if you see the B wave correct even further, if it goes down to 70%, now this again where rules versus guidelines come in. There is a 78.6% fib level. If you're a currency trader, you're very familiar with it. I'm going to get to this in a minute, but 61.8 is my favorite fib level. And in the currency world, 78.6% in trading currencies is to 61.8% in trading stocks or trading derivative options on stocks. So when he noted this, even though acknowledging there's still one more fib level to go that we could bounce off of on this B wave correction at 78.6, he noted that if you get to a 70% correction, highly likely that you're actually forming a flat rather than a zigzag. And a flat is a sideways pattern. So that's where the A and the B comes down and the B retraces almost all of A, and then the C extends back to where A was. In the end, you've just moved sideways. So that was his note there, even though there have been opportunities where the B wave went to 78.6 and you still had the C wave extension in the zigzag. So staying with rules or guidelines, the wave C must be longer than 90% of the wave B by price. So that's a key rule there. And that's where we start to get into every 5 wave pattern starts with a zigzag. You're not going to see a wave 5 pattern setup unless this is followed. So that ABC may stay as an ABC zigzag, or it could turn into a 1, 2, 3, and a 5 wave pattern. But for our purposes, when we're talking about zigzags, the wave C has to be longer than 90% of the B by price. Now we have a qualified potential zigzag. In general, and I'm going to give you even some more specifics here in a moment, in general, the wave C moves about the same length as the wave A. So you measure the price level from the 0 point, which is the start of A. How far did A move price-wise? Once the B wave correction is done, that's a reasonable expectation on where the C wave is going to go. But as I said, there's more details in here. Second most likely is for C to extend 61.8% of A. And then there's also an opportunity for an extended C wave where the C goes to the next fib level past the expected target of the C wave. So that may sound confusing, so I put it into a bit of a chart here, which I think clarifies it a little bit more. So if you have a zigzag setup where the B wave retraces 38.2%, the first in our, I'm say R, mine and Elliot's view on a corrective move, then you're looking for an expectation of a 61.8% extension on the C wave. So you're not necessarily looking for that C wave to go the 100%, to go the same distance as the A wave did. That's if the B wave only corrects to that first major fib level of 38.2. Now, oftentimes, and this has been around even longer than Elliott wave has been, anyone that's ever traded knows that after you get a decent impulsive move, you oftentimes get a 50% correction of that move before that trend resumes. If you get a 50% B wave correction, you are expecting that C wave to extend 100%, which means that C wave should be the same distance as the 0 point to the top of the A. And then my favorite that sets up, and you can see it's third most likely. And you're like, well, why would that be your favorite if it's third most likely? Well, you'll see in a moment. If that B wave retraces to what I think is the strongest of all fib levels, 61.8, and bounces, now you've got a good pullback, and you're looking for that C wave extension of 100%. Again, the move from B to C is the same distance price-wise as the move from 0 to A. And the reason it's the third most likely is you go back, and if we stop at 38.2 on the corrective move within the B wave, you're not expecting as long of a C wave extension. If you correct 50%, same move higher. But to get to the 61.8%, we've had to move on the B wave correction past 38.2, past 50. So to get to 61.8, pardon me, you've had to have already a B wave correction of 38.2 or 50. Both of those had to have occurred already. So that's why it says third most likely, but it's still my favorite of all the patterns that we set up. Have a high percentage of accuracy when you see that. So the simple trading plan, let's go through a plan on how to implement this, how to put it into action. So we look for the basic trading setup of a zigzag, and now we identify some specifics. One of those is a signal day. Then you qualify the trade. What can I make? What am I risking? Obviously, we want the risk to be greater than or less than the reward. We want the reward to be greater than the risk. You enter upon what's known as a confirmation day. So we don't enter on the single day. We wait for further confirmation. That just ups again the percentage of accuracy. I oftentimes state in webinars and speaking events that the market loves to give head fakes. It loves to fake in the retail trader, and you bring them in and then you get a reversal the other way. Pardon me again. So we want to make sure that we have an extra little piece in there with that confirmation day. Then once you're in the trade, there are rules on how to manage the trade while you're in it and then get out for the exit. And we look at Fibonacci levels, we monitor volumes. And then I've been a believer that no one should rely, if you're a technical trader, on any one technical indicator. There's a myriad of them out there. You've seen them. I feel like in back testing for all the years that I've been doing this, that I've tried them all the ones I know to exist. I like the DMI. It's one of my favorites to look at as far as confirming what's going on within Elliott Wave and what's going on with the AI. So we're adding that in as a initial confirmation indicator. If you're not familiar with the DMI, it was invented by Wells Wilder, who also invented RSI. So a lot of people look at RSI. That's one of the reasons that I like to look at it. Too many people look at it. So I like the DMI. I think it's even better. So identifying the opportunities, once you have this setup, we've identified the 0 point. So if we're looking at an upward zigzag, which is the examples that we've been going through here, you normally would have had a downward move. And the downward move stops, and then we start to change direction. We have that A wave impulse. Then you get the B wave correction. We know the rules. The B wave has to correct at least 20% of that A wave move, and then the C wave extends 90% at least of that B wave correction. So in time, you will get to the point. Remember, we're not looking for yet the wave 3 to be labeled. If you're just trading the zigzag setup, you can get to the point where you start to kind of cheat down a little bit on this 90% rule. In other words, you're looking for what fib level did that B wave bounce off of? And if it's a primary fib level, like it bounces off the 38.2, or it bounces off 50, or it bounces off 61.8, I will enter before that 90% rule on the C wave is entered. Get you in a little bit earlier. And then the Fibonacci levels give you your targeted exit prices. What was the B wave correction? Is our target 61.8? Is our target 100? Are we set up? And this is where the DMI really helps as well. If you have a C wave and it extends to the target at 100%, but the confirming indicators are saying this trend is still really strong, this C wave move is strong, which happens a lot in a wave 3, we might hang around there, tighten stops, whatever, but hang around to see if that C wave does indeed extend to the next fib level of 161.8, where you can actually get a little bit more out of it. So we identify the signal day. That's once that 90% rule has been achieved within the C wave. So that's the signal day. It's not the entry day, it's the signal day. Now we're looking for, when do we get in? So that's when you get your confirmation day past where that initial signal day was identified. So qualifying the trade. Here's where we go through and put everything into application. So we have the setup, that ABC, just a 3-segment move. And by the way, Elliott never called these waves. Somehow that evolved over time. He commented that the market moves like waves in the water with impulses and corrections, but he called these moves segments. And then it evolved into Elliott wave theory. But there's the setup that we just talked about. So there's our entry threshold. So we've had the signal day and we've had the confirmation day. We're in. If that move were to go back towards the B and hit that B wave point, that's your risk. That would be a failed setup. Now, this is before the AI came in and gave us the fail zones. This is just basically staying with Elliott wave at this point in time. And then what's our expected reward? Where did that B wave retrace? So which fib level is our target price? And that gives you the idea of the reward. And again, obviously you want your reward to be greater than the potential risk when you get in. common sense standpoint there. And so higher pivot point, if the B allows you to reduce risk, it all depends on where that B wave goes. So there's a lot of key on how far did that B wave correct before that C wave extension comes along. So other considerations when you're looking at this, how large is your zigzag? How far can it run before it runs into resistance at one of those fib levels? Those are key. You get this, you're going to start to get a handle on it. You'll start to feel, as an options trader, I oftentimes will get out before the target price is hit. If there's a strong move on a day and there's IV, implied volatility, that's been injected into, say, the call options if we're looking to the upside. And I want to take that. I've always viewed an IV infusion as free money, even though it may not have hit its actual price target yet. If it slows down, even though the stock continues up and hits its target, if the move was slower, that IV comes out, you might not make any extra money by waiting. So why wait when that's there? And then when we look at trading options, I have a very specific way of setting up what the strike prices are going to be, and it's based on where's the greatest delta gamma acceleration within the delta curve. So we're getting pretty specific now, but it's all math. The Greeks, as they call them within the world of options, are mathematical formulas. And so there's a delta gamma relationship which tells you based on the delta curve, which just doesn't move from lower left, upper right in a 45-degree angle. It's a big lazy S. So there are points on the curve where you can get greater acceleration. So the confirmation is, when will we get in? Note that after you have a zigzag setup, how do you know when to pull the trigger? So the confirmation day, we talked about that. We have the signal day and then the confirmation day. And it has to do with price. And I also still, even with AI involved here, want to see that the confirming indicators are also showing strength to the move. So here's an example. So we've got a zigzag setup here. You can see the A wave impulse, the 0 point, just what we talked about. And this was an actual example. So we had a downward move. We got to the 0 point, flattened out, based a bit, and then took off in an impulsive run in the wave A. Then we had the B wave correction. You can see right at the 61.8% level. So like that setup already. So 61.8% pullback. Then we get a move to the upside. So there's our setup there, which means that we now have a qualified pattern. You can see by the blue there, it's moved the 90% requirement for showing you that we have a setup. And then the confirmation day comes, and basically what you're looking for in the confirmation day is a close above the high of the signal day. That gives you the hard rule on when to get in as far as the confirmation day. As I mentioned earlier, if you see a B wave that bounces off that 61.8% and you're a little more aggressive by nature, some of us are conservative traders, some of us are more aggressive, you could kind of step in on that first day after the bounce above the 61.8% level, or you can stay hard fast to the rules, wait for the signal day, wait for the confirmation day, and feel like that's a little bit more prudent. Again, we all have different risk tolerances. So one of the rules, I do like it when the confirmation day is the very next day after the signal day. You can even go out on the internet and read in terms of the definition of a confirmation day. Some will say that there can be a day or two in between, a couple days before the actual confirmation day comes in. And there are times like that. But I think the stronger signals are when that confirmation day comes the next day after the signal day. All right, so we're in. How do we get out? That's the key. Take your profits. When can we get out and take our profits? I mentioned to you I like that IV infusion, so I don't always wait for the target price to be hit. And if the pattern fails, that's it. It hits the fail zone, comes back to where that B wave was. That's your exit. That's your stop. That's when you're out by following those rules. So if you like this information, if you find it interesting, do have an offer for you. And we talked about the play off of my previous golf career. Hopefully everybody can see this now. We have something called Top Shot. Basically, we have within Elliott Wave options 3 primary portfolios, all have been infused with AI, and a speculative portfolio, which I've been around a long time, so I still identify things that may not fall within those specific rules that we've identified for subscribers in those portfolios. That's called the speculative portfolio. So there's 4 total. In Top Shot, what I do is I cherry pick each and every week one potential alert from one of the portfolios. So the best of the week, if you will, if you want to call it that. And then we send that out through SMS and or email. You have access to live weekly trading sessions. So I do a number of live events each week. All of them have a Q&A. And the entry, it's a no-brainer. $99 a year for this. That's it. The cherry pick, one alert per week for $99. What a great deal. And that's not per month, that's per year, just to be clear. And then here's what the offer page looks like. I'm going to go back and show it to you on a slide so you can get the URL. But as you move down, you can see I've always talked about how there's a lot of similarities to my golf career and trading, and the fact that it didn't matter if you played the same golf course every single day, every single round was going to be different. You're going to be in different spots, and trading's the same way. There's a myriad. We don't limit the opportunities. We look at the broad market to find where these patterns exist and set up. There's the multi-powered network. Time strategy is sideways. Volatility are triangles. And then the impulse is what I've been describing to you today, which is zigzags within the wave 3. Again, all of which have been infused with AI. And so here's a detail. If you go to the web page, this is the actual web page, and these are all the things that you receive, which is a myriad of information. Not just the alerts, but the weekly live updates and briefs, an ebook. We include education. We really pride ourselves. If you're new to Elliott Wave, we went through and constructed our Elliott Wave education just as if you were taking a class, because it kind of is like learning a new language with all the terminology, etc. And you go chapter 1, 2, 3. Don't go to chapter 2 till you finished 1. Same thing that Elliott said when describing his algorithm. And become part of our community. We also have, when we do our live events, not only can you ask me questions live, but you can interact with others. So there's a chat window as well, and they share ideas back and forth. Another way to learn and identify ideas that they find out. So there's the results. You can go through and look at them again, and go through and find out all the information. A little bit of chatter there about our AI and how it works, etc. People have asked for the AI algorithms. Obviously, that's their intellectual property. I'm not going to give that away. They won't give it to us. They own it. So we just take advantage of it, basically. And there's the general setups of what those 3 portfolios do. The sideways movement following a big drop. There's an IV infusion there that we take advantage of. Triangles break out. Elliott himself said, when you see a triangle, forget everything else. It doesn't matter what the Elliott wave pattern is. Triangles are going to break out, and there's misinformation out there, in my opinion. Ascending triangles, people say they're going to break to the upside. Descending triangles are going to break to the downside. This is a symmetrical triangle. I can tell you, and we've run the AI data, any triangle can break either direction, so please don't get caught up in thinking you can pick what direction you're going to break out of a triangle. So we set it up to where it doesn't matter. We use those triangles with the delta gamma acceleration to take advantage of that, and then the impulse one is the one we've been focused on. You can see my golf swing there. That was at a trading event called Traders for an Edge. Anyway, all these different Q&As down here, and then you come down to the bottom, and there's the application form, the entry form. $99 a year, everything that's included. Put in your name, address, put in your phone number. That's not because we're going to call and market you. That's because we need it so we can send you out SMS alerts. And then your address information, make sure the form's filled out properly, and then your credit card information goes in, etc. And that's it. That's all it takes to kick the tires. It's a no-brainer, I think, at $99 a year to get cherry pick trade each and every week. So go ahead and show you the URL. You can see it down at the bottom here. It's ewotrader.com/top-shot-MH. So that gives you an idea there of what you're looking for and getting to that page, evotrader.com/top dash shot dash MH for Matt Hedge. So that's your special offer, and opportunity for this. Again, I think it's an absolute no-brainer. So I thought what I'd do is give you an idea, just show you actually how it shows up on the software. And so over here on the AI list, when we see this, this is what the first thing that I do each and every day. What's the current list? So here's one that you can follow. EWS showed up. Now this is run at night, so it was run last night, so it's ready to go first thing the next morning, and you just click on the symbol. It's that easy, and then there's the setup. And so we look at this, and I didn't look at this before we started this, because I like to, in the events that I do when we talk about AI setups, I like to look at them live so that I'm running through in my mind what I'm looking at, what I'm seeing, and then that gives an opportunity to people to know my thought process, rather than having a preset and coming, with already what to look at. I think you learn more if you hear the entire thought process. So when I look at that, the first thing I see is a 77% score. That's good. We're in the wave 3. We know that because, again, as I mentioned, the only Elliott wave piece of all the AI side of things is that it's the first day the wave 3 labels. So they labeled the 1, 2, and 3 all at the same time. Now, the next thing I'm going to look at is how far can it move. A negative here is when you look in the scale on the right, even though it looks like this stock moves a lot, each one of those blocks is only 50 cents. So this isn't necessarily a big mover, but it's the ETF for Singapore. And then I come over here to the zigzag tool. When I look at this actually worked out to be a good one, and I swear I didn't look at this beforehand. There was your triangle right there. So there's a triangle that was set up here on this ETF. You can see the pattern there of lower highs and higher lows right through there. Lots of touches of the line. That's what I like when I'm looking at a triangle. And then you get the breakout move. So it looks like to me that that's a zigzag. So I would want to come here. This is clearly the breakout day. So there's the A wave impulse. How far did we correct on the B wave? And that one went past the 78.6% level. And you look at that and say, well, that's disqualified. Well, it is, but it did go to the 100% extension anyway. So imagine the accuracy when you have one that's set up within the rules. So I would not have taken this one with the expectation, and it may still do it, of moving up to that next fib level. And if we bring it down, there's the potential move up to 161.8. But from this standpoint, it's not what I would consider a qualified zigzag because the B wave corrected too far. Now, some people, some Elliott wave people would come back and say, well, why didn't you start it at the wave 3 beginning? So you would come back down here and draw your zigzag from there. And I'll tell you why, because then you look at it and say, wow, that was a 61.8% correction. We're likely going to that 100% extension. It happens to coincide with the AI target. I wouldn't argue with anybody that liked that setup and wanted to do that and said they view it from this move. My point would be that I want the A wave to be a true impulsive move. It's not a true impulsive move when we have a triangle in the middle, which is a consolidation pattern. So that doesn't count to me as part of an impulsive move because it was a triangle. So people can vary things. And when we're looking at the zigzag, we are not always starting at where that 2 wave was labeled. So different adaptations, different theories. I'll be sharing mine with you as we go through and we talk during the live events, etc., throughout the next year once you signed up. And I'll give you my theories. You could disagree. You could say, I still like that. I like it coming from where the 2 started. So I gave you my opinion. I like starting where that first breakout day was. That looks more impulsive to me than the start of the wave 3. Difference of opinion. And that's one of the cool things about Elliott wave is you can adapt things, pardon me, to suit your own preferences. And then the next one on the list would be CRS. That's only a 70% score. I wanted to go ahead and show you that one due to the fact that even though the guidelines, notice that that pill looking thing up there, the 70% is in gray because our go signals are 75 or above. But my experience with these signals has been I'm happy to go at 70%. So I don't necessarily only wait for the signals that are 75 or above. So when we're looking here, once again, where did the start of the impulsive move go? Not necessarily where that two was, although you could make a greater case for that in this example than to me in the EWS one. But I would start here, and then this one has multiple zigzags in it. So we have a complex C wave here. In fact, this is a flat. It gives me an opportunity to show you the flat. So we're at exactly right now the 100% extension. It was perfect. So the complex move here would be the fact that we had this move down, followed by a move back up to test that A wave high, and then we came back down and we had a flat. Now you look at this and you say, yeah, but that flat came back to the B wave. I thought that's where the fail zone was, and that's where you would get out. And normally that would be correct. And you would have exited this one and not caught that move. But let's remember all the rules within Elliott wave, and it is intense. That's why we spend so much time on the education. That was a flat in there. That was a corrective phase within the zigzag, is another complex C wave. So on this one, I would have moved into this, even though I wouldn't have done the EWS one, just simply on where you draw the zigzags from. So we'll go through, we'll talk about all those rules. You can see there's a lot to it. And the key thing here, this is one of my big things. We joked about it in the beginning. I'm a golf pro. The average person can do this. I'm not a Harvard MBA. And I try to do my best to remember how I felt when I first started trading, drinking from a fire hose, use your favorite analogy, and going through the process of learning. And I try to explain things not as someone on Wall Street that talks in gibberish and code at times, to explain it to the everyday average person on how this works. And again, I remember how I felt. Not the smartest guy in the room, so I remember that, and I'll go through and explain it to you in layman's terms as well. So that's what I wanted to share with you. That's what I wanted to show you. Hopefully you found that interesting and informative, and I do appreciate being here. And with that, I'll send it back to you guys.
All right, thank you very much. Great presentation, and even learned something about golf. So thank you for joining us. Look having you back in the future.